Hi, let's continue our discussion with the second source of financing, bank credit. So banks these days provide all type of loans for businesses, individuals, institutions, provide self-liquidating loans in which there is an built-in automatic repayment scheme based on the loan you're approved for. Then you have a schedule of payments per month, per number of years, and so forth. We are going to cover all these type of loans next. Changes in the banking system today are significant. There is high competition among existing banks. They want to offer you full service banking to get you as a customer. This day, some banks offer cash payment if you open up an account with them. I hear that Citizens offers $400 if you open up an account with them. They also expand internationally. Branches of banks in United States functioning in Europe and around the world, and foreign banks functioning in United States. And also these days, bigger banks, more powerful banks buy out the smaller ones to have a stronger capital. There are lots of changes in the banking system associated with the recession, the most recent recession, 2007 2009, also called the Great Recession. And I'm going to post additional videos just with this concept if you are interested in. But as a quick history review, based on the legislation that happened in 1999, this act, and also there was another act, the legislation that was repealed, that this is Glass-Steagall Act was repealed in 1991. And because of this fact, banks were allowed to become riskier in their behavior. They were allowed to engage in investing activities on Wall Street. And because of the greed and because they wanted to make lots of money fast, they did so. They packaged mortgages in the so-called mortgage-backed securities, and they sold them on Wall Street. And investors, like individual institutions, governments, they purchased those AAA rated investment mortgage-backed securities that in reality carried lots of risk. And what happened inside these mortgage-backed securities, there are a lot of mortgages. They were based on variable rate of interest, meaning people buying their houses opted for ARM, or variable interest rate, the one that's low for a number of years and then increases. It resets to higher level. And then people have to pay higher and higher mortgages. I'm sure they didn't understand that that was going to happen. And this is when people lost their houses, people couldn't pay back their mortgages, and all this, the so-called AAA investment mortgage-backed securities, started to default on payments, and investors couldn't receive their money back, and that was one of the causes of this recent recession. Now, some of the banks learned their lessons after that, and they introduced stricter restrictions. Now you need a much higher credit score to qualify for a loan, and you need to pay back the down payment has to be higher. But some of the banks, probably they still take more or less risk. That was just an introduction about the banking system in United States. And when it comes to interest rate, the benchmark for United States, it's called prime rate, cost of borrowing. So if you are the best qualified person or company, the one that has the best credit score. So in our case, as individual, higher than 800 points would qualify you probably for a prime rate. If your credit score goes down, then you are going to pay higher interest rate when you borrow money. It's going to be prime rate plus 1%, 2%, depends how low your credit score is, or you cannot qualify at all. The equivalent of the prime rate in Europe, it's called LIBOR. is the benchmark for cost of borrowing for interest rate in London interbank system. And always investors look and compare prime rate and LIBOR and see where they can have more advantages for borrowing money or investing money. And historically, let's take a look at this two cost of borrowing. This is for United States in red, so you see it used to be really high, early 90s, 2000, and then went down, and then went high again, and then since then it's been down after the recession, because if you recall, Federal Reserve System reduced interest rate to ease the monetary situation in United States and make individual businesses borrow more money for the economy to recover faster. So basically for the last 6 years or so, we had a very low interest rate, 3% or so. And in Europe, the benchmark was even lower. As we speak, 1 week ago, actually, there was the so-called Brexit as a political change in Europe, where Great Britain voted to exit the European Union. So we have to wait and see what kind of political and economic consequences we have as a consequence of this political event. Some say that there might be a recession in Europe, and the United States might be affected as well. We just have to wait and see. Next, what we are going to discuss, instead of following the PowerPoint with all these bank loans, is the same type of information, but I created a document for you with all type of bank loans that we are going to go over. And then in the next video, we are going to do applications on problem solving for this type of loans. So from chapter 8, this is going to be posted in this module for you to have when you study. We have different type of loans. One loan is called, we try to figure out the interest rate or cost of borrowing, effective interest rate for all these type of loans. The first one is called effective rate when the loan comes to simple interest. What it means that if you borrow, as a business, if you borrow money for this type of loan, then you have this interest rate to be paid in dollars, or you pay at the end of the period when the loan comes due. And you calculate the effective interest rate in percentage as interest, how much interest you pay in dollars, divided by principal in dollars, times days in year. It's considered 360 for ease of calculations. And days loan outstanding. If it's 6 months, it's 180. If it's 1 year, it's 360. So this whole fraction cancels out. Another type of loan, it's if you are perceived as a riskier type of business, maybe your credit score is a little lower, then the bank would say, okay, you are approved for a loan, discounted type of loan, and you pay discounting interest. What does it mean? It means that you have to pay the interest up front and take the rest of the money you borrow home. The bank wants to make sure it gets paid first. This is what the deduction means. So the effective interest rate is going to be calculated as interest in dollars, principal you borrow, minus you pay the interest up front, and this term is the same as previous one. Another type of loan is a loan with compensating balance. It means that the bank requires you to have some amount of money called compensating balance in a separate account that you cannot use. This is just for the bank to withdraw their money in case you cannot pay on time. So that's if you are a riskier type of business, your credit score is even lower. And you calculate this effective rate for a real long type of loan, interest in percentage 1 minus C compensating balance. So for example, if they ask you for an interest of 2% of, let's say, 5%, and they ask you for a compensating balance of 10%, that's going to be 0.10 divided by 1 0.05 if interest is 5%, divided by 1 minus 0.10 if compensating balance is 10%. If you have different type of length of a loan, then you can use this general formula: interest in dollars, principal in dollars, compensating balance in dollars, and then that's the same type here that we used before. And if you have to borrow more to meet the compensating balance, you don't have that extra money, this is how much, that's the formula you use to figure out how much you have to borrow to end up with the compensating balance required that you have to put aside and take home the rest of the money. And finally, that's another type of loan that we should be familiar with. It's the loan that we use when we buy a car, for example. We pay back the loan in installment. So look for the next video on application on this topic.